Hey everybody, what's up? How's it going? Robin here once again. Welcome to today's video. And inside today's video, I'm going to be showing you guys 15 stocks, 15 Canadian dividend-based stocks in my WealthSimple trade portfolio. So if you guys are brand new to the channel, this dividend-based portfolio I built at the start of this year, and throughout 2020, I've basically been building the dividend portfolio, and every single week I've been posting an update on this channel showing you guys what stocks I've been buying, my earnings, and all that kind of stuff. So if you guys are brand new to the channel, and you guys want to check out my dividend investing case study, I'll link to the entire playlist in the description of this video. You guys can check that out if you want. But in this video, we're going to do like a really big deep dive, and I'm going to talk about all the stocks I hold. I'm going to talk about the stocks I'm going to be buying in the future. I'm going to let you guys know which ones I'm going to be keeping and ones I'm going to be getting rid of. And of course, I'll show you guys the returns and everything I've got over the course of the year. So once again, I built this portfolio at the start of the year, and then I think we're about month 7 now, going towards the middle of month 7. So it's a 7-month portfolio that we built completely from scratch. So let's jump inside my WealthSimple trade account and let's see how our stocks are doing in our portfolio. And very quickly, guys, I just want to say, if you guys are enjoying this video, you guys want to see more Canadian-based dividend investing content, be sure to subscribe to the channel and give the video a big thumbs up if you enjoyed this video. Alright guys, what's up, how's it going? Welcome back. We are inside my WealthSimple trade account. This is my 100% Canadian based dividend portfolio here. Well, I guess it's like 95% Canadian based because I do have an old international ETF in there, but I don't really have many shares. I bought that like when I first started the portfolio. So and we do have some US stocks as well. So I'd say it's like maybe it's pretty heavily based Canadian stocks, but over time you are going to be balancing it to be more a little bit kind of in between Canadian stocks and US stocks predominantly. But this is my tax-free savings account. We have $4,217. This is the total portfolio value, and then we can see over the course of one day we are up $3.58, which is 0.09%. Over the course of 1 week, we are up $77.95, which is almost about 2% over the past week. So Canadian stocks have actually had a nice little increase over the past couple weeks. Everything across the board that I hold with Canadian stocks have actually gone up quite a bit. So it's been pretty nice, and ever since the crash happened, like US stocks jumped up really quickly first, and now we can kind of see like everything else is starting to kind of follow suit, and that's Canadian stocks are doing really, really well. So it's going to be interesting to see how far they're going to go, if they're going to keep going up. But right now we're doing pretty good with our Canadian stocks. Over the course of 1 month, we are up 3.22%, which is $126 with the portfolio, which is pretty sweet. And over the course of 3 months, we are up a whopping 8%. Oh, actually, pretty much almost 9% of the past 3 months, which is really good. Like $345 to be up with a $4,218 portfolio is pretty sweet. And we're just reinvesting those dividends to keep it growing, because I do think I think stocks, especially Canadian stocks, are going to rise over the course of the next little while. We'll just have to wait and see, what they actually get to, kind of thing. And over the past year, which is pretty much the whole time stats of the portfolio, we are up about 3%. So this includes pre-market crash, market crash, and then where we are today. So we did have a little bit of money invested before the crash, not tons of money, but I think we had about maybe $1,000-ish. So a good chunk of the portfolio when you think about it. So that's why, even though in the past 3 months we are up like 8%, but all time we are actually down about 3%. So that's the reason why. So now we're going to dive into individual stocks, and one thing I want to point out really quickly is that this portfolio is based off solid Canadian stocks. I'm not one to really invest in a lot of like brand new stocks or things that don't have a good history. I like to play it safe. I like to invest in stocks that have a good history, that have good growth, are good companies, dividend aristocrats, all that kind of stuff that, have good earnings reports, are constantly increasing their yields, their dividends, and they're just growing over time. And I think when it comes to dividend investing, that's the most important thing, because you want stocks that are secure, stocks that have growth, and you can rely on that yield. Because the last thing you want is yield to get cut like a lot, or to lose out a lot of money that way, because most of your earnings will come from your dividend yields. But at the same time, like a lot of good solid quality companies will grow in stock appreciation as well. So you can kind of combine the two together, you can get a lot more bang for your buck. So the first one we have here is Bank of Nova Scotia, and I love Canadian banks. I'm a big believer in Canadian banks. Most of Canadians' market is in the finance and stuff like that, and you'll see that a lot of their better companies are kind of like bank stocks and insurance companies and different things like that. So the first one I'm going to talk about is Bank of Nova Scotia. This is one I bought a little while back, and I probably will be buying more shares of it over time. The only problem with the Canadian bank stocks is that their shares are kind of expensive. Like Bank of Nova Scotia is $57, so you can't buy it here and there kind of thing. But we currently own 3 shares, total value of $173. Average price is $50.69, and this represents about 4.43% of my portfolio. And we are about total return of $6.18, which is about 3%. So not too shabby overall. And you can see the stats here at the bottom. So as you're going to notice is Canadian bank stocks have really good yields. Like Bank of Nova Scotia is currently sitting at 6% yield, and I don't think they're going to cut their yields because their banks are just really solid. They have good earnings. Most solid, like the bigger banks are pretty good, right? I don't think they're going to cut their dividends anytime soon. So as that appreciation grows over the next little while, we can also enjoy some nice dividends going into the future. So I think they're really good stocks to buy right now. The next one is another Canadian bank. This is CIBC. This is my actual personal bank that I've used pretty much my whole entire life. This one is a lot more expensive than Bank of Nova Scotia, sitting at $97 per share, and we will be buying this one more in the future. Just like all the other bank stocks, I probably will hold about 4 or 5 of the big ones, I think, inside my portfolio probably until the end of time, because I just think they're that good. So we have 2 shares here, total value at $195, which is 5% of my portfolio, and overall return of $8.34 with 4.46% overall, and they have a nice good dividend yield of 6%. One thing I want to mention really quickly is WealthSimple Trade sometimes doesn't have the 100% correct dividend yields, so just double check anything just in case, because I have noticed sometimes they're either behind or they're like a couple days behind or something, or there's just been display issues. So just kind of keep that in mind, guys, as you're watching these videos. Next up we have is Enbridge. Enbridge is a utilities and energy-based company out of Canada. They are probably one of the bigger popular Canadian dividend stocks that, if you've ever been investing for any amount of time, you've probably heard people talk about Enbridge a lot. And we bought 3 shares in the past, and I probably will buy Enbridge going into the future. I'm just not sure because they do have like really high debt ratios and payout ratios and stuff like that, and although I don't think they'll die as a company, I'm not too sure if they're going to be able to withstand their dividend going over time. We'll have to wait and see. I think maybe there's some safer, better plays to invest into, but they do have a nice dividend yield, and they are a company that's just done well over time. So it's hard to say, right? But I would probably bet that they probably will be fine. But you never know. Their dividend might get cut because, as you guys see, it's almost 7%, which is pretty high, especially since they didn't cut it this year yet. But I got 3 shares of Enbridge, total value $130. This is about 3.35% of my portfolio, and as you guys can see, it's about 6% return. So far, it's performed pretty good, and we're going to keep getting that nice yield going towards the end of the year. And I do believe they pay out quarterly, like most of these stocks do. Next up we have is Fortis, and Fortis is kind of like the opposite of Enbridge. It's a more safer, more defensive stock. They have better financials, better payout ratios, so lots of room for growth going into the future, and I don't think you really have to worry about them cutting their dividend or anything bad happening. Now, we bought Fortis not too long ago, actually. It was about a couple weeks ago, so as you guys can see, we have 3 shares, $161, 4% of my portfolio, but we actually had a negative gain, and this is because, once again, I bought this, I think it was about a couple weeks ago, so it's still pretty new in the portfolio, so it hasn't had time to really grow or decrease yet. So that's kind of why it's like that. And they have a nice more conservative yield of 3.47%, but I do expect that to increase over time in the future. And so I think Fortis is a great stock to invest into right now. So definitely a good defensive utility stock to hold. Next up we have is Manulife. Manulife is an insurance-based, financial-based company in Canada. This is actually the benefits provider I use for my work as well, and they're pretty good company. Very good history of doing really well, and I bought into them kind of, about a month or 2 ago, and I think they're going to be one of the better stocks that are going to perform, kind of recover really well. Like if anything's going to recover, it's going to be Canadian banks, it's going to be finance. Oil, we don't really know yet. We've seen a little bit of recovery, but we'll have to wait and see. But we own 4 shares of Manulife, $80 value in my portfolio, 2% overall, and you look at this, guys, 9.31% return. It's a really good return for Manulife. I wish I would have invested more shares, honestly, like especially at $20 a share. I could have bought a lot of shares, but whatever. I'm just going to keep buying it as time goes on because they do have a good dividend yield of 5%. So 9.31% gain already this year, with 5% going into, like really good opportunities here, guys. And once again, the Canadian dollar is pretty low, so I like the idea of buying Canadian stocks because it's cheaper than US stocks, but of course I will buy US stocks because US stocks are pretty solid. And you can't go wrong with US stocks. They just have a good history of doing well. Next up we have is Polaris Infrastructure. This is one I bought a little while back when I first started the portfolio. I'm not too sure if I'm going to keep investing with this particular stock. We have 12 shares, $14 a share, 4.53% of the portfolio, and not very good return, but pretty good yield. I'm not too sure if I'm going to keep Polaris. I might keep it just until it kind of gets maybe towards the end of the year, and we'll see where the gains go. If it gets a little bit higher, I might sell it, but I'm probably just going to keep the shares for now. It's only $177 the portfolio. Might as well get like the dividend yield and have it grow over time. But probably going into the future, I won't be buying Polaris anymore. I'm not too sure. We'll have to wait and see, but it's not really a stock I'm probably going to be buying going into the future. Next up we have is TransAlta Renewables, which is another utility-based company. This is $15 Canadian is pretty cheap. I bought this one way in the beginning as well. I think I bought a bunch of shares, and I've kind of been buying a few here and there as well. We have 14 shares, total value $218 Canadian, almost 6% of the portfolio, and once again, pretty solid returns at 9.80% total return with a dividend yield of 6%. Like, this is crazy gains. I think going in the future, like, I know a lot of people are talking about like 2020 is a bad year, but guys, if you stick with it and you invest in 2020, especially in Canadian stocks and probably US stocks as well, like those two are the big ones, 2020 is going to be a good year to make money. Like, you know, and the funny thing is people are going to look in the past and be like, holy crap, stocks took a big crap dive, people lost a lot of money, and on paper it'll look horrible. But if you guys invest during this year, you're going to come out with crazy returns, and it might be once in a lifetime opportunity for you guys, especially if you guys are just starting out to get a nice big head start. But for you guys who already have a decent sized portfolio, I think it's going to be an opportunity to really like take it to the next level. So I'm just throwing everything I can into Canadian and US stocks because I do think they're going to do well, and there's such good opportunities with these, good stock appreciation that could probably happen towards the end of the year, and the crazy dividends that you get to hold until the rest of the time, right? If you buy these shares at these prices, and like say their dividend yield is 7% right now, or 6% or something like that, and they don't decrease their dividend, you've locked in that dividend yield for the rest of time for the shares you bought during that period. So tons of opportunities right now. The next stock we're going to talk about is Sliveria Corp. And this one was recommended me from a user from I can't remember who it was. If whoever recommended the stock, let me know in the comment section, because this stock has performed ridiculously well, like just stupidly well. And I remember them saying like Sliveria is they're a accessibility company. They make like products and stuff that help people do things, right? Like people who are disabled, people who are older, kind of thing. People who have trouble with things, right? And I only have 5 shares, $16 Canadian. But look at it was only 2% of the portfolio at $81. But look at the return, guys, 23.49%. If only you would have known, right? But you know what? I'll take it. Like, it'll help out. But I'm still probably going to invest in them just slowly here and there, because obviously they already got that big jump up. Who knows if they're going to keep jumping up, right? But I'm just going to probably stick a couple shares here and there when I have some free shares. But 2.95% dividend yield. So Sliveria Corp, wish I would have invested more, but hey, you know what? We still got a pretty good return. Not too shabby. What do we have next? Next up we have is Shaw. Shaw Communications is a internet and communications company. Pretty popular here where I am in Northern Ontario. Actually, in fact, the internet company I use is Shaw Communications, and they've been a pretty consistent dividend-based Canadian stock. They also have a nice monthly dividend, which is really cool. And we have about 10 shares. This is the first stock we have bought in this portfolio, and basically, like, I've been buying a share or two here and there, kind of thing. And it's $249 value of the portfolio, 6%, and total return is 5%. So not too bad, and a decent yield of 4.69%. And once again, the nice thing about Shaw is they do have a monthly dividend, so not too shabby. Like, I'm not going to complain about that. Pretty good overall. Next up we have is TD. Probably one of my favorite stocks on this list, and probably one of the best bank stocks overall. $63 Canadian for a share. Once again, I will be adding more bank stocks in this portfolio once I just get more money. They just cost so damn much. But we have 4 shares of TD, total value $254, 6% of the portfolio, 8.69% return, $20 overall. So pretty sweet returns from TD. Good yield, and Obviously, the yield has gone down to 4.78%, but it was a little bit higher when we started buying these shares. So we'll be getting some nice dividend yields off that. So TD, definitely really good stock to buy. Really good safe bank stock. I don't think anything's ever going to happen to TD. They just got such good financials. And I've talked about them a lot on this channel in case you guys haven't noticed. So that's all the individual stocks in the portfolio. Let's do a quick little talk about the different ETFs I have. So the first one we have is VDY. And this is a Vanguard-based Canadian High Dividend Yield Index. So it's just a collection of a bunch of the biggest, most well-known companies that have high yields in Canada. So it's kind of a little bit of protection just in case if I pick really stupid stocks, at least my ETFs will carry me through. And I want to ideally make this about 40% of the portfolio if I can, maybe even more, but we'll see. Probably not, because I'm going to make the other 40% US stocks and then use the 20% stocks to pick my own stocks. But we have 21 shares. This one we bought before the crash, during the crash, and a little bit afterwards. So the returns are a little bit across the board, obviously, and they do have a nice monthly dividend yield, which is really nice. So 21 shares overall, total value $653 Canadian, and 16.69% of the portfolio, and our overall return is 2%. So once again, that doesn't look very good, but the yields will come throughout the rest of the year, and we did buy a lot before the market crashed. So it's going to take some time for this one to kind of get some nice gains. But it will over time kind of like add up and stuff like that. But it's definitely one of the ones that got hit the most by the crash, and predominantly because we just had so many shares before. So we're still kind of recovering, right? Just goes to show you guys, if you invest, during the crash, how big of a difference it really makes. I'm not saying you guys should time the market or nothing like that, but you can just kind of see that we took an advantage of that, right? Like, we kept our shares in before. We're going to benefit from that. We're going to gain value as time goes on, but we also invested during the crash, so we got a bit of both worlds. Next stock we have is VYMI. I don't have very many shares of this. This is just an international ETF. I'm not going to be buying more of these. I just don't think we need international stocks inside this portfolio, so I'm going to keep it there until it recovers, and that's about it. Next up we have is XHD. This is my Canadian hedged US based ETF. I bought the hedged version because I thought that with the Canadian dollar being so low right now, this might be a good buy, but I'm not too sure, guys. I'm still kind of learning about hedge funds, and I might buy a different US stock, like a different Vanguard fund or something like that. I'm not too sure. But let me know what you guys think in the comments about this, if you think this is a good idea or not. Or if you can recommend any US-based ETFs, but we're going to go with this one for now, but I think maybe over time I might switch to a Vanguard fund. We'll just have to wait and see. But we have 30 shares in this one, total value $795, 20% of the portfolio once again, and total return is 2%. Once again, we had a large number of holdings in this ETF before the crash, so we're still kind of recovering, and a nice little yield of 3.4%, and it does pay monthly, like I mentioned, so that's really nice as well. Next up we have XRE. This is a REIT, a Canadian REIT. REITs got hit pretty hard, but they're starting to kind of recover. This one we had 28 shares, and we bought pretty much all of these shares before the market crash. So this one's obviously sitting pretty low at 12%. We're going to keep buying XRE though, because as time goes on and it recovers, it will do well and we'll gain nice little gains. Total value is $420, and 10% of the portfolio. And a nice yield of 6%. That's pretty solid yield. So XRE, if you're going to be buying REITs right now, XRE might be something to look into because it's got a nice yield and it hasn't grown that much yet since the crash. So I still think once it recovers, you'll do pretty well. And at the very bottom here, we have ZWC, which is a Bank of Montreal Canadian ETF. And this one has done pretty good, actually. 11 shares, 4.45% of the portfolio, and 7.72% return overall. With an 8.3% yield. Might want to double check that one. I'm not too sure if that's 100% accurate. Seems a little bit high, but you never know, it might be. And then we have $300 that we're waiting to deposit, and I'll probably do a video in a couple days, show you guys the stocks I'm actually buying with that money. So make sure you subscribe to the channel if you guys want to see that. But that's pretty much the stocks individually. I know this was a pretty long video, but I just wanted to cover that. And once again, if you go all time, everything kind of added up together with my losses plus my gains. It's 3% right now, which, some of you guys are going to be thinking that's not very great. But keep in mind, a good chunk of this portfolio was made before the crash, and a lot of stocks haven't recovered yet. So we're still kind of waiting on that. And last thing I'm going to do before I end this video is I'm going to jump into the investment spreadsheet and show you guys the actual returns we've had from this portfolio when it comes to dividends. Alright guys, so this is my investing spreadsheet. I'm just going to show you guys in case any of you guys are new to the channel and you're curious about this. Once again, I do a more deeper update about my dividend portfolios and all my dividend-based portfolios, because I do have 2 based ones in the dividend investing case study series. So check that out if you guys want to see like more of a weekly update on how things have gone since I've started investing inside this portfolio. But basically, on our first month of January, we made $44.44 in Canadian dividends. We made $1.61 in month 2 in February. March, we made $4.35. April made $5.22, and then May $7.79, then $12.96 in June, $13.22. So we're starting to kind of get up there. And then in August so far we made about $3. And total dividends earned in the portfolio combined together is about $48. So we're slowly starting to get there. And once again, guys, we aren't reinvesting all of our dividends back into the portfolio. This total portfolio earnings includes my REITs, which is in a separate portfolio. So kind of ignore that. That's not part of this portfolio. But that's pretty much it, guys. So I hope you guys enjoyed this video. Hope you guys enjoyed me just giving you guys a quick update on my portfolio and my Canadian stocks. So let me know what you guys think in the comment section. I hope you guys enjoyed this video, and be sure to like the video and subscribe to the channel if you guys want to see more Canadian based dividend investing videos. So thanks for joining me here today, guys. Have yourself a good day, and I'll see you guys later.